Hello everybody. In week 11, we are going to learn how central bank uses monetary policy to control money supply and aggregate demand of an economy. Monetary policy is referred to adjustment of interest rate and money supply by central bank. Monetary policy aims to maintain domestic price stability, achieve optimum employment of resources, and achieve higher rate of economic growth. Central bank is a government-owned and operated institution that controls commercial banking system and quantity of money in the economy. Central bank can use three tools to control money supply, namely reserve requirements, discount rate, and open market operations. Commercial banks are privately owned and profit-oriented institutions that provide a variety of financial services. These include accepting deposits from customers, then the bank uses these deposits to offer loans. In order to protect depositors of commercial banks, each individual commercial bank is required to keep minimum fraction of deposits in the central bank. It is a cash required reserve ratio for meeting unexpected mass depositor withdrawals. The higher the required reserve ratio, the lower the ability of commercial banks to generate credit for money lending. Therefore, this reduces money supply. The second tool that central bank uses to control money supply is discount rate or bank rate. It is the interest rate that central bank charges on loans it makes to commercial banks. A lower discount rate reduces borrowing costs. This encourages commercial banks to borrow reserves from central bank. This allows commercial banks to offer more bank lending to households and private firms. Therefore, increases money supply. The third tool of money supply control is through the open market operations. Through this open market, central bank can buy and sell government bonds and securities to commercial banks. When central bank buys government bonds from a commercial bank, central bank pays for the bonds by increasing cash reserve of the commercial bank. Therefore, the commercial bank can increase its lending to households and firms, which increases money supply. Based on the three money supply controlling tools, there are two types of monetary policy that can be implemented by central bank, namely expansionary and contractionary monetary policies. Expansionary monetary policy is used when central bank would like to increase money supply by purchasing government bonds, lower reserve ratio, and discount bank. On the other hand, contractionary monetary policy aims to reduce money supply through selling government bonds, higher reserve ratio, and discount rate. With the implementation of expansionary or easy money policy, central bank will increase money supply. As a consequence, commercial banks reduce interest rate. This reduces borrowing cost that encourages household spending and firm investment. Therefore, aggregate demand will shift to the right and real GDP increases. This policy is suitable during economic recession period for controlling unemployment. In panel A, the economy begins in a recession at point A with real GDP of 13.8 trillion and a price level of 98. An expansionary monetary policy causes aggregate demand to shift to the right from 81 to 82. This increases real GDP from 13.8 trillion to 14 trillion and the price level from 98 to 100 at point B. With real GDP back at its potential level, the goal of high employment is achieved. Contractionary or tight money policy helps central bank to reduce money supply through higher reserve ratio and discount rate. As a consequence, commercial banks will raise interest rate that increases borrowing cost. This reduces household spending and firm investment. This leads to left shift of aggregate demand and reduces real GDP. Therefore, contractionary monetary policy is suitable for controlling inflation. In panel B, the economy begins at point A with real GDP at $14.2 trillion and the price level at 102. A contractionary monetary policy causes aggregate demand to shift to the left from 81 to 82. This decreasing real GDP from 14.2 trillion to 14 trillion and the price level from 102 to 100 at point B. With real GDP back at its potential level, the central bank can meet its goal of price stability. In summary, monetary policy is used by central bank to adjust interest rate and money supply. Central banks control money supply through reserve ratio, discount rate, and open market operations. When an economy has high inflation, contractionary monetary policy should be used to reduce money supply. On the other hand, expansionary monetary policy is more suitable during recession. This is because easy money policy increases money supply that increases aggregate demand and real GDP.